Coming to investing activities. What are investing activities? Those activities which result in either the acquisition or disposal of long-term assets. And by long-term assets we mean fixed assets. So students, such activities in which either we acquire long-term assets or we dispose them off, they are covered under investing activities. Again, when we acquire fixed assets, that is when we purchase new fixed assets, we pay cash. So it results in cash outflow. Whereas when we sell fixed assets, it results in inflow of cash, hence cash inflow. So various activities which are covered under cash inflow are sale of fixed assets, when we sell fixed assets, when we sell investments, when we receive interest on money already invested by us. That is, there are some investments in the business and we are receiving interest and dividend on that money invested by us. So these receipts, that is the interest and dividend, would also be considered under what we call as cash inflow from investing activities. Coming to cash outflow, that is those activities which result in outflow of cash. It can be of two types: purchase of fixed assets. Let's say you purchase building, you purchase land, so you will pay cash for that. It would be a cash outflow. Similarly, when we purchase investments, that is money that we have invested in some other shares of some other company or in the assets of some other company, they are called as investments. So whenever we purchase investments of some other companies, it will be leading to cash outflow from investing activities. Financing activities. Financing activities includes those activities which affect the capital employed of a business. They affect the money invested by the owners in the business or the money investment by long-term borrowings. So now students, the cash inflow on account of financing activities include issue of shares or issue of debentures in cash. So whenever we issue shares or debentures in cash, we receive a large amount of funds in the form of cash and bank deposits. So it is a major source of cash inflow. Similarly, proceeds from borrowings. When we borrow money from banks and other lenders for a long-term period, it adds on to the capital employed in the business and it is a source of cash inflow from financing activities. Now, these amounts have to be repaid also. Whenever we take loans, these loans have to be repaid. So whenever we pay loan, it becomes a part of cash outflow from financing activities. Then students, redemption of preference shares and debentures. Redemption of preference shares and debentures means redemption after the term has expired. So whenever we pay money back to the preference shareholders or to the debenture holders, it also becomes cash outflow from investing activities. Then a new concept, that is buyback of equity shares. Now recently it has been allowed that a company can buy back its shares from the market. So whenever a company buys back its shares, it leads to reduction in capital employed and a certain amount of cash is to be paid to the existing shareholders. So that payment leads to cash outflow. Again, lastly, any kind of dividends or interest paid by any form of company. That means dividends on shares and interest on long-term borrowings lead to cash outflow. Now students, a very important part to remember here is that interest and dividend paid by any company. By any company we mean that is a company in manufacturing sector or a company which is of financing or which has investment as its major businesses. Even for those companies, if dividend and interest are paid on the capital employed, then that is to be treated as a cash outflow from financing activities.